Request everyone to please be silent. Please. आवाज ही नहीं। Good morning again, friend.
Morning.
Request everyone to please be silent and keep your phone on silent mode. Friend, first of all, I am very sorry to inconvenience all of you due to short haul, small haul. But as you know, Kohinoor Hotel is going on renovation and upper hall was also booked. So we booked here and please bear with us to smooth functioning of our study circuit. Friends, I hope everyone had a refreshing break and enjoyed the brunch. Now that we are recharged, let us gear up for the third and final technical session of the day. We are privileged to have with us CA Ronak Doshi ji, a highly respected speaker known for his clarity and command over complex tax matter. In this session, we will address several key and nuanced issues under the Income Tax Act that professionals regularly faces in practice, like Section 45(4), Section 194R, non-compliant conversion of company into LLP, loss of investment in subsidiary, etc. Friends, these topics often lead to interpretational issue and gray area, and we are confident that CA Ronak Doshi will provide much needed clarity with practical example and insight. क्योंकि फ्रेंड, कानूनी जाल हो या टैक्स का टेंशन, रोशन सर के जवाब हो हर एक क्वेश्चन, आईटी एक्ट के इन पेचीदा राहों का है सफर, जो हो जाए आसान उनके मार्गदर्शन से। अगर to give a formal introduction, I call upon our past convener, CA Anil Sharma ji. Please come.
Welcome back. Thanks to our convener to give me this opportunity to introduce our today's speaker, Ronak Doshi, who is a BCom FCA partner of Mansi Mehta and Company, well-known CA firm for decades. Doshi has the distinction of having completed advanced diploma in international tax from Chartered Institute of Tax, UK. He has more than 22 years of experience in the area of domestic and international taxation advisory, business reorganization, litigation, transfer pricing, and regulatory compliance. He was a member of the International Taxation Committee of the Chamber of Tax Consultants and has also contributed to it to its recent edition on international taxation comparative and transfer pricing portfolio. He speaks on various professional forums on direct and international tax aspects and has also contributed research papers on international taxation development for panel discussion and has written articles on the above area of practice. He speaks regularly on various study circles, professional organization, corporate training, which includes income tax department. He appears regularly before the ITAT. With this brief introduction, I welcome him and I also request
संजय पिछली वाला जी कॉलेज नाम का लगभग ये कम
yes. अभी से मैं भी जाऊँ
Over to you, sir.
Good morning, friends. At the outset, I would like to thank JB Nagar Study Circle conveners and everyone who thought that I can shed some light on the 4 topics which we are going to cover today. I think I don't have the luxury of good shairis as Sir spoke, but suffice to say that all the 4 topics when I was preparing, and despite whatever experience each of one has, because a lot of seniors are there also, colleagues, friends and all, but I think it's a fit topic when we say that, look, we have all learned something, we need to unlearn and then relearn. And specifically that phrase will definitely apply insofar as the first topic which I'm going to cover. So the first topic, friends, we'll cover 4 topics in next 1 hour or so, 1 hour, 5-10 minutes. And at the end of this 4 topics, we will take maybe 10-15 minutes for answering some questions and answers which anyone has on the audience. The first topic which the conveners told and what we deliberated was a topic which is very new or recent, if I call it. And as I said, the topic is section 45(4). Now, friends, as I said, up till this amendments came, which amended section 45(4), introduced another section known as section 9B, came out with certain rules, as also one CBDT circular which clarified or confused, I don't know, but be as that may. Up till that point in time, whatever we had learned, insofar as taxation of partnership, partner retiring, etc., was one thing what we learned. Now, when we look at the provisions with a fresh mind, we feel that law has completely changed. And now, new law would mean that maybe some principles of old law will continue to apply, but substantially, we have been told by the legislature that, look, we want you to read the new law, that is 45(4), read 9D, and accordingly compute the tax liability if we come across certain particular transactions. So with that, let's start with the first topic. Briefly, I'll touch the other 3 topics which we'll cover. Second is also something which I think day in, day out, a lot of us are asked this question as professional, that either a company, private limited firm, or an unlisted public company wants to convert into LLP under the LLP Act, and it's not possible that all these 6 conditions stated under that particular section 4713A are complied, and what are the tax implications. Third topic, which is not that much in depth, but is more based on judicial pronouncements, is a topic where we will deal with as to when I write off the investments as a holding company in my subsidiary or the off subsidiary, whether I get a tax break, what are the pros and cons under which head. And last is a famous section 194R, which we all have now learned or at least dwelled upon last couple of years. But still, I will try to draw a few practical instances and then we will discuss. So friends, just for benefit of everyone, while we'll just have brief two or three slides on what are the basic provisions. And then what I have done is to explain the provisions. I have taken case studies so that it is easier for me to explain the provisions. So friends, as I said, today we have two new sections, 45(4) and section 9B. Now, most important thing, friends, which when we start this topic is that so far all of us have learned that capital gain under section 45 starts only when there is a transfer of capital asset. Transfer is defined, as we all are aware, under 247. And therefore, we always presume that only if there's a transfer of capital asset, the act or the charge is on the transfer of capital asset. And then you compute the capital gain as per the provisions of that chapter. Take into account section 48, mode of computation, etc., section 55. Now, for the first time, if one notes the amended 45(4) section, it starts with a non-obstant clause. So it says notwithstanding anything. So that means we have to keep in mind that, okay, the basic charge under 45(1) has to be ignored when we start this section. And the crux of this section is what? It is a tax on receipt and not on transfer. So that is very critical. Under 45(4), what we have been given to told is that whenever there is a reconstitution, which is defined under the explanation to section 9B, and we'll come to it as to what does it cover in the next slides. But if a partner gets money or a capital asset, and for the purpose of the remaining slides, we will call them as defined under law a specified person. If he receives either a money or capital asset as a result of reconstitution from the specified entity, and for this purpose, we will just presume firm, then we have been told that, look, though this is a tax on the partner under 45(4), but we wish to tax the firm. And therefore, the firm will be taxed in the year in which the partner or the specified person receives money or capital asset. So that is the first part, that is a 45(4). Now, insofar as section 9B is concerned, section 9B is a section which says that, look, apart from reconstitution, it also covers dissolution, but there the subject matter of receipt is capital asset and stock in trade. And there it has been said that whenever a specified entity, that is a firm, transfers, whenever the specified entity or the firm, transfers, or it's a deemed transfer of capital asset or stock in trade to a specified person, then the firm will be liable to pay tax. Now, therefore, what are the critical parts of both this section? One, the charge ultimately, because of deeming fiction, also is always on the specified entity, that is a firm. Second, both these sections apply only in the year in which there is a receipt by the specified person. And third, the subject matter per se can be, while 45(4) covers capital asset and money, 9B will cover capital asset and stock in trade. To that extent, insofar as the capital asset is concerned, both these sections would apply. Apart from this, in the table, as you would see on the right hand side bottom, there is one more peculiar thing under section 9B. Now, section 9B says that whatever is that, because of the deemed transfer, the firm will either compute on transfer of capital asset capital gains, or the firm will compute income from business. Now, while the section says it is in accordance with the provisions of the Act, 9B3 says the fair market value of the capital asset or stock in trade will be considered as full value of consideration. Now, therefore, one question which can come is that if we just concentrate first on 9B, now one section 2, subsection 2 says that in accordance with the Act. Subsection 3 says that look, it is full market, fair market value is your consideration. So question which may come up is whether when I have to compute 9B, and because it applies to capital asset and stock in trade, and for simplicity's sake, let us say that that particular capital asset or stock in trade is a land. What would you consider while computing 9B in the hands of the firm? Would you say that, look, because it says in accordance with the Act and the subject matter of deemed transfer is a land, can I resort to 50C? Can I resort to 43CA? Or I say that no, for this subsection, they say only fair market value, and fair market value is not defined. I'll go to the definition, which means that there may be a controversy as to whether if the subject matter is something which in accordance with Act refers to a particular section, whether that will override, or I will say no, fair market value. That is one. Second, both these sections technically operate independently. And now in terms of the circular, we have got a direction to say that, look, generally start first with 9B, then come to 45.4. Now, today the discussion is 45.4 and stock appreciation. So we'll have to keep in mind this formula under 45.4, which, as I said, the triggers we have already seen. Now what we are saying, the capital gain under 45.4, as and when that section is triggered, is to be computed as per this formula. So A is income chargeable to tax under 45.4 as capital gains. So it will always be capital gains. And if the formula is B plus C minus D, B is nothing but in simple terms cash or money. C is the fair market value of the asset or of the capital asset. And D is the capital balance in the hands of the partner who is retiring, for simplicity's sake. Then we have also been given to tool that, look, if you give effect to this formula and A results in a negative figure, then deem it to be 0. So the department is very clear that if it ever comes to negative, keep it 0. Otherwise, it will always be positive and you pay capital gain tax. Also to be noted is that while computing the capital balance, insofar as D is concerned, one has to ignore the revaluation on account of revaluation or any increase in capital on account of self-generated assets, goodwill, etc. And one more point before I go to the next slide is, because I told you that 9B first has to be given effect to, and we will see in case studies, the capital balance which you consider here as D should be after giving effect in the books of accounts to the section 9B transaction. And that will come to it. So if in 9B I've got something because of which in my books of accounts of the firm, I'll have to first increase the capital balance net of tax. And that balance will be now considered insofar as 45.4 is concerned. Now, the heart of the matter is that what is a reconstitution? So as we said, 45 applies to reconstitution, 9B applies to reconstitution plus dissolution. Now here reconstitution, really in simple terms, if I put it, it's simply that if one or more partner retires, but otherwise other partner continue and the firm continues, so there is no dissolution. If I add one or more partner, but some of the existing partner, at least one should continue. And third is simple, that I have a change in the PSR. Now, therefore, one will have to, so now we'll have to look at this transaction. And at this point, I'll make a brief reference that there was a Supreme Court judgment, which you all know, Mansukh dying, where unfortunately, fortunately, Supreme Court takes a view prior to all this law to say that mere revaluation and a credit to partners capital account also was covered under 45.4 earlier. In my mind, that judgment is not right, but today it's Supreme Court, so it is the law as of land. Then we have two rules, friends. Rule 8AA5. Now, 8AA5 and 8AB are the two rules which will always be kept into mind when I do 45.4. Essentially, what we are saying today, when there is a reconstitution, in substance, okay, it is my interest in the partnership, which let's take an example that I retire from a partnership firm. In substance, my interest in the profits is something which is getting extinguished. But the way now the law has been created, that factor, which is a very simplistic understanding that today when I retire, my interest in my profits are getting extinguished, and that is a capital asset which I'm leaving. Now law says that okay, that may be a factor for reconstitution, but the computation methodology is not simpliciter based on that. So therefore, to determine, what is the ultimate, whatever you compute in 45.4 as capital gains, as to whether it is short term or it is long term, is based on this rule 8AB5. And we will come to it as to how we decide whether it's short term or long term. And in certain cases, really whether we can decide independently that it's neither short term nor long term. Then this is something which also is very important. So now in the scheme, friends, you have been told that look, whatever capital gain tax you pay under 45.4, which has capital gain will be payable only if the partner or a specified person is getting something beyond the capital. So let's assume a positive figure. Then they are saying that look, when a partner is getting something beyond the capital, it is impliedly only for a reason that he is getting something which is beyond the books. So today the presumption is that look, some other assets of the partnership firm would have been much more than the value. And today, if I am retiring, I would have negotiated with the existing partner that no, today if the assets of the firm are sold or revalued, I would have got something more, and therefore that excess you give me. So now the law says that look, to the extent the gain is there, you have to attribute to the remaining capital assets which continue in the partnership firm. And then the sub rule 2, 3, and 4 decide into which cases how you will do the attribution, and in which case you will not do any attribution. Now, very important, friends, to bear in mind when we do the case studies, that effectively this attribution is nothing but an amount which you're going to. So whatever tax you pay today under 45.4, if any amount is attributable to remaining capital asset and revaluation thereof in substance, then to that extent, that element will be allowed to you in future under 48.3 when you sell that capital asset in future, so that there is no double taxation. So these are the provisions. And last thing before we come to case study, friends, that please bear in mind that 45.4 is a self-contained code. So as I said, it is not withstanding 45.1, but not only that, you don't have to go to 48 also, because the formula is also mentioned under 45.4. So it's a self-contained code in itself. Now, therefore, when we did and we were preparing, we found that these are the steps which generally you would follow in case you are concerned with any such transaction. First, compute 9B. What is the income under 9B? Based on the 9B income, you will add the net of tax balance to the respective partners in their PSR. That capital balance becomes the D base when you apply 45.4. Once you get a 45.4 figure, then we decide, okay, whether I should attribute something to other capital assets, and ultimately whether that 45.4 is short term or long term. So these are the 5 broad steps which one has to follow. Now with that, friends, let's understand. I have taken very simple case studies for understanding. So first case study, friends, we have been given to told that ABC is a partnership firm comprising of 3 partners, Mr. A, Mr. B, and Mr. C, equal PSR. Now Mr. C wants to retire, so he is retiring with effect from a particular date, and the firm decided that look, on retirement, the firm wishes to give him land on retirement. Now, for the purpose of calculations, we have assumed capital gain to be 20% and the normal tax rate at 30. Now let's go step by step. And if you also see the balance sheet, so we are saying the left-hand side columns in each side are the carrying amount books of account. So original it is 300 as capital, 100 as liability. On the asset side, my assets are land 100 and plant and machine 300. Now today, if I have to revalue my assets, whatever happened, I come to know that my fair value of land is 400. So there is an upward revision of 300. Insofar as plant and machine is concerned, the case study presumes that the value is same. So now that 300 is additionally allocated to ABC, so to tie up the balance sheets. Now, friends, here again, let's start step by step. So first is what is the subject matter of receipt? The subject matter of receipt is land, and land is a capital asset. So that is what we have to presume. Now, since land is a capital asset and capital asset is covered in the 9B and also 45.4, as per the steps what I explained, first we'll have to compute what happens in 9B. So if you see the left-hand side of the screen, friends, 9B simply says take the fair market value of the capital asset, which is 400, minus the cost. Let us ignore indexation for the time being. So minus 100, so 300 is my capital gain. And we are presuming tax at 20%. So tax at 60. So now, friends, what is the remaining net of tax figure? 240. Now this 240, we have to equally divide amongst the capital account of A, B, and C. So therefore, if we see earlier the capital balance was 100, now the capital balance will become 180 of Mr. C. Now, if you see, then I come to 45.4. So on 45.4, it applies to money and capital asset. A equals to B plus C minus D. So now what is, there is no B in my case in this example as money. It's only C, fair market value of asset 400 minus the capital balance of Mr. C who is retiring, specified person 180. So it's 220. So now first we have arrived at, okay, under 45.4, it is 220. Now there are two more questions which you have to answer. Is something to be attributed out of this to the remaining capital assets as required under 8AB? And thereafter we have to decide as to what component of this 220 or the entire component is short term or long term. So now, friends, in this example, what we saw, that while the partner is getting something more and the land is a subject matter of receipt, there is no other appreciation or revaluation on other assets at all. The only other asset with the partnership that is plant and machinery, and we have been given to told, okay, look, that value has remained the same. Now, if that value has remained the same, and there is no other capital asset remaining with the partnership firm. Therefore, that allocation will fail in my mind. Now the question comes as to then in that even this 220 rupees in our example, it will not be attributable to anything, that is fine. But this 220, I have to pay tax as what? As short term, as long term, as what? Now, friends, if we just see rule 8AA, yeah. So if you see rule 8AA5, friends, what it says, in case of an amount which is chargeable, so in our case 220 under capital gain, the amount or part of it, that is the 220, shall be deemed to be transferred from short-term capital asset if it is attributable to short-term block of assets, self-generated, etc., and otherwise long-term. Now, as we saw, friends, there is no other asset remaining at all. Therefore, what would happen to this 220? In my mind, I may be wrong, but in my mind and my personal view, when a partner is getting something beyond, and first already effect is given under 9D to the capital, to the increase in the land value, that means impliedly there is some goodwill which the firm had, which is not recognized in its books. And therefore, a partner is still getting something beyond the land appreciation. In my mind, the answer should be that this 220 is nothing but a short-term capital gain, is what I have come to conclusion in this. So that is insofar as first case study where we only took capital asset. Now, this case study, second, I have taken a case where other facts remain same, friends. 2-3 changes One, now I've added that the retiring partner is going to get not only land, but also stock in trade. And here let us presume that the land is urban land and therefore a capital asset. So therefore, I've also added one more factor. On the asset side, I've added one more depreciable asset, building. So now if you see the balance sheet drawn at the bottom of the screen, my land was in the books valued at 160, fair market value 300. My building was valued in the books at 400, fair market value 500, and stock in trade was valued at 40, but the fair market value is 100. So again, if I revise here my capital balances, because of the increase of 300 on revaluation, my capital now will be each be 300. Now again, friends, let's go again step by step for understanding. 9B first. So now in 9B, what happens? I have two assets, capital asset and stock in trade. I take the fair market value as 300 and 100. I reduce the cost, that is 160 and 40. Resultantly, it should be capital gain and business profits. And the tax is 28 and 18. And therefore, if you see now the revised capital balances. Now, why I have written U1, U2 is just to highlight. Now, here is a case where you are transferring capital asset and stock in trade both. So a doubt can arise. I don't think there's a doubt, but doubt may arise is that should I also attribute the net of tax increase in the stock in trade also to the capital balance of the partner, which is view one. So I take both the assets, or I said no, only capital asset, that is 300, 160, 140 minus 28. I should only take that. In my mind, one should take both, and therefore the revised capital should be 251. Now after 9B, let's come to 45.4. So now friends, under 45.4, as we said, it only applies to capital asset. So I will take 300 minus my capital balance 251, and the capital gain is 49. Now, as we've said, the next step is, okay, we have come across that 49 rupees is 45.4. Now, is it attributable to any other asset, okay, which the firm is going to continue? So therefore, let's go back. Now what we are saying that, look, you have to really see the attribution only of the capital assets retained by the firm. And here we have been told that, look, the building will continue, and building is a capital asset, and there is an increment of 100 in building. So now when you attribute 49 rupees as per rule 8AB, it will be 49 into 100 divided by 100, because that is the only asset which is going to continue. And therefore, if we apply these formulas, we come to a conclusion the entire 49, which is a 45.4 tax, is attributable to the building. Okay, that is what it will come to. And since building is building falls in the block of asset, it will be a short-term capital gain. Now, since on this point we are there, one more thing which I have a doubt, and I don't have a ready answer. The way the law, the circular is there. Now you say that, okay, 49 rupees is attributable to building. Fine. Therefore, what you are saying that as and when in future the firm sells the building, it should get the deduction of 49, because on that tax is paid today. But 49 is in the block of asset. Therefore, how does one give effect to 48.3? Now, there is some confusion in my mind in the circular also. But in my view, what will happen, since you are paying on 49 tax, the year in which block ceases to exist, in that year, probably you may give effect to that. But for that, it cannot be that in this year, after you give effect to 45.4, you add this 49 to the block. There is no addition to any capital asset. The only says under 48.3, you will reduce the following tax which is paid earlier. And then we come to the final case study, which is the topic today, I think. And again, I made it very simple. So here I'm making the third variation. I'm taking a view that, look, the Mr. C is retiring, but the firm has decided that we'll pay him cash. Now, obviously, when one sees the case study, you see the cash of 30, you are wanting to give him 500. So let's presume that the firm will get a cash from other partners or whatsoever, but firm will give him cash of 500. Now here, friends, please note, all the asset side, you have plant and machinery, book value 60, fair value 100. Urban land, which is a capital asset, 110. and 200. Goodwill not recognized in books, but fair market value, I got a valuation done, which comes to 270. And then cash and bank balance will remain the same. And there is stock in trade, which is there. So friends, here, one more important thing why I have focused on urban land is, so here in case study, we have presumed that it's a capital asset. Please bear in mind that if you find any item which is not a capital asset, let's say an agriculture land, then for the purpose of the attribution, you will have to ignore because it's not a capital asset at all. So now let's again do our same methodological working. Would section 9B apply? It's money, right? So we said that 9B will not apply. 9B only applies insofar as capital asset and stock in trade. So I'm very happy I have to cut the first step, no 9B. Now let's come to 45.4. So now, because 9B is not there, my capital balance will remain as it is. Now, therefore, 45.4 says what simply? Take the fair market value of capital asset or stock in trade. We don't have stock in trade here. So I take 400, capital asset, money, I take 500 rupees, sorry. And my opening capital balance 100. So now 400 is my 45.4. Now, friends, we have to decide that, okay, I computed 45.4 of 400. Now, two questions will still remain. Do I need to attribute any part of this 400 to the remaining assets which are continued by the firm? And thereafter determine as to how much I have to pay short term and long term. So friends, if we go to the next slide, therefore, if you see, now here what we are saying, I have to add, we came to a figure of 400. Now I have attributed 400 in column D, if you see, 13 towards plant and machinery, 30 towards land, 90 towards goodwill, and 267 towards stock in trade. So now this is the main question, which was the subject matter of the first part of today's discussion. As we saw, there is substantial amount attributable to stock in trade. Now, the law, as we saw under 8AA, only says that, look, ultimately 45.4 is only capital gains. And the bifurcation of 45.4 has to be always done on short term and long term, as per rule 8AA. So what do I do of 267? The remaining part, fine, plant and machinery, land, goodwill, I understand. I can attribute, etc. But what do I do of 267? Now, therefore, real question is, how will you tax 267? Will you not tax it? What does the law provide? So friends, these are the real three options. One simple view of the matter could be that, look, the charge under 45.4 requires you to divide it between short term, long term. Now this 267 is stock in trade, is not a capital asset. Therefore, I cannot break it up into short term, long term. The mechanism fails and I don't pay tax on this appreciation of stock in trade. So that is very strongly arguable in my mind. Also, the factor is that, and I think probably it is rational, that is what my view is, because what you are doing when you're not taxing 267 today, because it's a stock in trade, you're not also adding to the cost. Because as we said in a rule 8AB, read with 48.3, what you attribute to capital asset only can be added under 48.3. So the law is that, okay, since I'm not giving a cost step up or a deduction, I'm not taxing you. So one option is this. Can second option be, now department comes back and says that, look, since you cannot allocate anything to 267, but it is part of 45.4, now let me take a simple view कि आपने interest in partnership वो extinguish किया है, how long you are partner, and based on that decide long term, short term. In my mind, I don't think they can do that. And third again is a question which also is a theoretical question, friend, that normally we bifurcate capital asset into long term, short term. But if we say that once under 45.4 some amount comes, it is part of total income, can I just say that I apply the slab rate on that and compute it? So this is a controversy which we wanted to highlight in first part, that look, you will be faced with a situation where if your stock in trade appreciation is coming into the calculation or part of 45.4, the mechanism may break and you may not be liable to pay tax under 45.4 unless law is modified or we get some further guidance. And for the first proposition, we just found obviously there are a lot of judgments, which we just have reproduced one Supreme Court observation where it says that in order to levy tax, there has to be three components: the subject of the tax, the person who has to pay, and the rate. If there is ambiguity regarding any one of them, the charge fails. So I think we can take a comfort that on that 45.267 in my example, relying on this judgment and this line of judgments, one cannot pay any tax. So I think with this, we will end this part. Then friends, we come to the next controversy is on section 47 3A. Now friends, all of us know that lot of our CA friends, lot of CA firms, and now a lot of other companies also, for practical convenience, for certain tax arbitrage and certain flexibility, let me put it that way, would like to convert a private company or an unlisted public company into an LLP. Now we have section 4713B. So as we know, friends, 47 exempts certain transfer. So first the presumption is there is a transfer, and if you fall in 47, you come to conclusion, okay, this is an exempt transfer. Now what does, so in brief, because we are not concerned with the clauses here, our question today is going to be what are the tax implication in case of it being a non-compliant demerger, non-compliant conversion. So here, for the sake of it, just let's read the first part. Nothing contained in section 45 shall apply to any transfer of capital asset or intangible asset by a company to an LLP, or any transfer of shares by the shareholder of the company on as a result of conversion to LLP, provided A to F or whatever the conditions are. Now, typically we know if you want to encourage LLP, the conditions are quite stringent and not many people will meet it. And therefore, when you don't meet this, we will call it as a non-tax compliant conversion. So now the question is, if today someone comes to us and asks that, look, I have a non-tax compliant conversion to LLP. The conversion is as per the LLP Act 2008, section 57, 58, third, fourth schedule, etc. What are the tax implications? Now, this I will come later, not relevant. Now, friends, so essentially we will have to answer three basic questions. Then there are other peripheral questions which I will deal. So three questions, friends. If it's a not tax compliant conversion, and therefore you say that under 4713A, I am not exempt, then can someone say, since you're not exempt, 45(1) say will apply. Can someone take away that, okay, the company has transferred the assets to the LLP, I will tax the company. Now, obviously, company will not cease to will cease to exist. So I will tax the LLP as a successor of company is the first question. Second question is, will I tax the LLP when it gets all the assets? And third is what happens in case of partners, partners who are erstwhile shareholders. So here, friends, these are three essential questions. Now, while I've taken this example to just show that the turnover was breached, and therefore we have been given to told that if the turnover is breached, 47(3) is violated. And for the sake of interest, we have said that the company had carry forward business losses and MAT credit, so that we can answer all the final parts of this controversy. Now, friends, first question is it a transfer by the company to LLP? Now, while I've listed judicial pronouncement, but I would like to state that today, under the LLP Act, there is a procedure. There are sections, there are schedule. And when I comply with all of them, the registrar issues a certificate of LLP to me that now the LLP is formed. If I follow all the procedures under the LLP Act, which is statutory, allows a company to convert itself into an LLP and thereafter continue as LLP, is there a transfer? Now, generally, when we understand transfer in common parlance, we say it should be two parties should be there, A and B, and the asset is transferred. Now, here, whether this is a transfer or not is a question. Now, friends, this controversy had initially started years back when there was a Part 9 conversion under the Companies Act. So there, the first time question came before the Bombay High Court in taxpayer. that look, when a firm has converted into companies under Part 9, whether there is a transfer or not. And that was a question prior to 4713 being added, because we know that similar to this section is 4713 as well. Now the Bombay High Court said that look, for transfer, there has to be two people. In substance, there is no two people here. The company is the same, the LLP is the same. Only the cloak is changed. So I've just changed the clothes. But in substance, the company and the firm remains the same one. Second, Bombay High Court said that while there is vesting of assets, it is not as a result of any sale deed or conveyance, but by statutory vesting. So that is second important part in Bombay High Court held. And third, it says that in any event, the shares which you issue to the erstwhile partner has no correlation with the asset transfer. And therefore, for asset transfer, there is no consideration and you cannot take market value. So that was a controversy in taxpaying, followed by Bombay High Court in another judgment of ME Cure, followed by Madras High Court also. Now, before I come to the highlighted judgment, which is there, now that was all part of Part 9. Now, immediately when this section was introduced, 4713, if I'm not wrong, from assessment year 11-12, there was a case of celerity power where a company was converted into LLP under the LLP Act, assessment year 11-12, the first assessment year. And there the Honorable Bombay Tribunal, despite the assessee quoting taxpin, took a view that look, taxpin was under Part 9, but here there is an LLP. Under LLP section, I'll read that section for everyone's benefit. So under LLP, under section 58, friends, I'll just read one para so that we know the context. It says, notwithstanding anything contained in any law for time being in force, on and from the date specified in the certificate of registration, all tangible and intangible property, assets, interests, rights, privileges of the company as the case may be, and the whole of the undertaking of the firm as the case may be, shall be transferred and shall vest in the LLP without further assurance, act, or deed. Now, probably the tribunal was swayed by the fact that, look, unlike Part 9, which only uses the word vest, here it is transfer and vest. And therefore, they took a view that, look, Part 9 logic cannot apply here. So on facts, on their interpretation, they took a view that, look, it is a transfer. But having taken a view that it is a transfer, they took a view that effectively what is happening, even if you transfer, the transfer of all the assets and liabilities is at book value, and therefore as a resulting consequence, there is zero tax. Now, friends, therefore, as of today, when we advise someone, this celerity power will be thrown to us. And it is a judgment of tribunal, right, wrong, so we have to go with caution. Now, when we were doing research, we came across another judgment of Himachal Pradesh High Court, and therefore for these two judgments, I've highlighted the dates. Now, interestingly, friends, in the case of Himachal Pradesh High Court, the question was that there was a firm which was converted into an LLP under the LLP Act. And in order to register the LLP and the name of the LLP under various state records, the state said that, look, the LLP has to pay a stamp duty and registration charges. And in that context, in this writ petition, the arguments and the provisions of LLP Act, etc. were seen. Ultimately, the Honorable HP High Court took a note of the fact they followed taxpin, but more importantly, they again reiterated that even if there's a conversion, where the language which we just read is transferred and vested, still they took a view in substance that, look, it is still a statutory vesting. There is no conveyance, there is no sale deed, there is no instrument of transfer but a certificate of registration. And because it is a statutory vesting, the Honorable HPI Court took a view after going through the provisions of the LLP Act that because it's a statutory vesting, there is no need to pay stamp duty or registration fee. Now, to my mind, therefore, again, as we know, friends, in our country, you have judgments on both the sides, and it always keeps on going one way or the other way. So now again, we have a High Court which supports the view that celerity power may not be the right law. But come what may, I think the answer is this, that as long as you are transferring the entire undertaking at book value, there is no charge, there is no actual capital gain. So therefore, to my mind, insofar as the tax liability of the company or the successor LLP is concerned, I think we still have a broad level comfort that there will not be any tax liability. One. Then second, friends, we come to a question that what happens in case of LLP. Now, in case of LLP, friends, sorry, yeah, in case of LLP, friends, what is LLP getting? The LLP is not transferring anything. They cannot be fortified. The LLP is getting the entire undertaking. Now we all know that undertaking itself is an asset, but fortunately for us, under the definition of property under 56 to 10, undertaking is not covered. And therefore, when the LLP gets the undertaking on a running concern basis, there may not be any tax implications insofar as LLP is concerned. And which takes us to the last questions, friend, that what happens to the shareholder. Now, there I think there is a bit of concern. So, friends, I am a shareholder of this company. In lieu of my shares, now I'm getting interest in the profits on conversion into LLP. Now, therefore, when my shares, my rights in shares are getting extinguished, as per Supreme Court in Grace Collins, it's a transfer. Once it's a transfer, so you say, okay, chalo, it's a transfer as far as shareholder is concerned. How do I compute the capital gain tax? Now, here, friends, until earlier we had a Supreme Court judgment in Sunil Siddharth Bhai, which took a view that the future interest in partnership has its own issues, and therefore one cannot determine, the worth thereof. But today, friends, that judgment was rendered much earlier. Today we have 50D, and where department will take up with that, look, you have transferred, you are agreeing, yes. You know the cost of shares, yes, I know the cost of shares. Now, if that is the case, only thing what I have to determine is consideration. And they will say that when you extinguish something in lieu thereof, you're getting some other asset. You find out the fair market value of that asset, and probably I've been told, I'm not an expert in valuation, but probably I've been told that post 50D, we chartered accountants also can have valued the future interest in partners based on some assumption. And therefore, to that extent, one can say that the computation mechanism works here. And that is what has been even held by this domino printing, which is an AR ruling, which takes away that, look, you can determine the capital gain. 50D applies, and therefore to that extent there can be an exposure in the hands of shareholders. Now, needless to add, consequential to the capital gain, because you are transferring unlisted shares, at best, in my view, you can go by 50 CA and say that, okay, whatever is 11-year value, you can take that and not beyond that anything. And the last consequence is, if that is a long term, and if you want to claim 54F, subject to other conditions, you can claim. So these are the three broad questions, friends, on this. Connected questions, friends, is what happens to the losses, what happens to MAT credit, what happens to depreciation. These are three main sections. Insofar as MAT is concerned, friends, the law is very clear, and rightly so. MAT applies to companies. You are no longer a company, and therefore the MAT credit is lost. Insofar as 72A is concerned, friends, please see the unique language of 72A. It says where there has been reorganization of a business. And then read further. Now, why we have highlighted, friends, this particular sections, just to show that each section has used the language separately. In some case, the language is subject to compliance of conditions under 4713. In some case, the language is predecessor successor. In some case, the language is only succession or devolution. Therefore, based on the sections and the language, one may come to different answer. But here what we have highlighted is, even if I had followed tax spin, let's say that law was correct, if there is no transfer, then also in my mind, there will be difficulty in claiming carry forward losses, because whether you comply 4713 or not, the conversion from company to LLP may still constitute a reorganization as per settled law. And once it is reorganization, you will not get the carry forward of losses. Insofar as depreciation is concerned, friends, in my mind, you will have to find the cutoff, divide the depreciation based on the number of days, and that would not make any difference whether it's a valid transfer or not a valid transfer. Now with this, friends, we come to the third topic, loss of investments in subsidiary, whether allowable or not. Now, friends, here there are a lot of case laws which are there, but predominantly, I feel that the first Supreme Court judgment is this Ram Narayan Sons, which is a three-bench judgment, which takes a view that look, in this case, as we all know, in olden times there was a managing agency concept. So here, this company acquired a share of another company which was a managing agent, and therefore it acquired control over that. The question is, when they divested the shares of that company, whether they could have claimed business loss or capital loss. The Supreme Court says that while we understand that you acquired that shares for getting managing agency, but per se you acquired a share which is a separate capital asset, nothing to do with managing agency, and therefore the Supreme Court said that it's a capital loss. Then we come across another divisional bench judgment of Patnaik and Company, where here the Supreme Court takes a different view. Obviously, the earlier judgment was not cited or considered, but here they take a view that if I invest in a government loan, and because of that I get more revenue in my contract, it is nothing but a business necessity. And tomorrow, if I divest that shares, it is nothing but a revenue loss which I can claim. So again, we are coming to a situation where there are both judgments. Only thing is that earlier judgment is a three-bench judgment, so a larger bench. Then we have our own Bombay High Court in Colgate Palmolive. Here again, friends, very simple facts. Colgate set up a subsidiary to manufacturing toothbrush to be supplied to itself. Ultimately, over a period of time, that subsidiary was making loss, and it sold the shares of that subsidiary. The question was that whether it's revenue or capital. Obviously, because the subsidiary was set up for my own business and for transaction with me, it was held that it is nothing but a revenue loss, SLP dismissed. Similar are lines are Karnataka High Court and Rajasthan High Court. And there are a couple of tribunal judgments. Then, friends, apart from this, the question is that if I give a loan to a subsidiary, and tomorrow if that loan is not recoverable, what are the tax implications? So, friends, here I would say that again, our basic understanding, I think we all are clear, is that what was the purpose of the loan for which you gave? If the loan was given to a subsidiary into same line of business, then probably the argument that yes, if you write off the loan, okay, it should be revenue can be accepted. However, there is a Punjab and Haryana High Court which takes away that whether same line or different line does not matter. To my mind, that's not a right judgment. And we have contrary judgments of Karnataka and Bombay High Court which takes away that look, it cannot be a business loss. But if there is a transfer of a capital loss of that loan, which is a capital asset, then it can be claimed as a capital loss. And then similar is a case of a Bombay High Court affirmed by Supreme Court in Siemens, where again it was a loan given to subsidiary. Thereafter, the loan was assigned at a very small value. Assignment was relevant because it amounts to transfer. Otherwise, one cannot claim any capital loss, and it was allowed as a capital loss. So, friends, here the key takeaway is only one. Whatever stand we advise our clients, it has to be consistent. Because today it should not mean that when I'm selling shares, I am saying business loss allow karo. Kal, if I divest a subsidiary, which is a profit-making subsidiary, I will say, no, boss, I want to claim capital loss. So I think one has to bear in mind and not be swayed by just one or the other judgments. And then takes us to the last topic for the day, 194R. So friends, under 194R, if you now that it's in statute since last couple of years, we will just touch upon key issues because I am sure everyone is well aware of 194R. So important is it is applicable to any person, okay, which provides any benefit of perquisite. And this is very important, friends, which I always feel we have to bear in mind, which should arise in the course of the business or exercise of the profession of the recipient. And then the other things will follow, that you ensure tax is deducted, there is a threshold, there's a 10% withholding tax rate, etc. So these are the key things. Recipient of the benefit should be a resident. To my mind, the provider can be a resident and can be non-resident. But typically in all TDS provisions, we see that while the word is any person, Generally, we have not seen department going after foreign people to say that you have not deducted tax. Now, friends, as we said, TDS ultimately starts, TDS is a mechanism to recover tax. And therefore, it all starts from the basic chart section 4. And this has to be borne in mind if we ever come across some subject matter of 194R where it's worth fighting, that does it give rise to any income? In absence of section 4 charge of income, the mechanism to recover tax should ideally not be there. But at the same breath, let me tell you that we all have seen last couple of years that when TDS was started, it was a recovery of tax on income, but now it has been expanded to every widest possible transactions, whether there is income or not. Then the department is very clear that as a deductor, we don't have to see whether it constitutes income of the recipient or not, which is contrary to the section 4 and certain judgments. Now, this also, friends, we have common. I'll just refer it in a minute. So what is benefit and perquisite? We all know in simple terms, any advantage, profits, privilege, any benefit which I get or perquisite is any such item. Now, this is, as I said, important because when we decide any subject matter of a transaction as to whether 194R is there or not, please ask the question, does it arise in the course of the business of the recipient? Now, arise, friends, is a very, very important word because in past judicial pronouncement, and if you see the judgment of Supreme Court also, it basically gives you a color that arise means immediate, first source, proximate. Something which is far-fetched cannot be arising. And therefore, this is very important that if you satisfy the test that yes, this particular benefit or perquisite has arisen immediately from the carrying on of business or exercise of profession, then you go ahead and examine the other implication of 194R. Now, question in our country specifically, but generally also that if today I get something because of my personal traits, whether it is a benefit or a perquisite. Now you have Supreme Court, sorry, this Madras High Court judgment where it was a case of a disciple and a guru, and the guru received something from the disciple. The question was, is it income? Is it a benefit? And the court said that, look, because there was a regularity between the disciple and the guru, it arose to the guru in the course of exercise of vocation, and therefore it should be taxed. In contrast, if you see a Karnataka High Court judgment where an MLA received something, apart from the fact that he was MLA, I mean, they said that, look, he had received not because of a quid pro quo and because of a personal esteem and affection, and therefore it should not be an income or tax. And they laid out these two broad tests. Now, this, friends, I think we can skip because while we initially all debated cash, whether covered, not covered, kind, etc., I think now we have to accept that, look, whether the benefit is in cash, in kind, partly in cash or partly in kind, all are today as we speak are all are covered. And then, friends, how do you discharge the tax? So either the payer, we gross it up and pay tax, either the payee pays the tax, either we give him net of tax, or there is enabling circular which says that let the payee pay the advance tax, give you that challan, you tag it in your system and you can discharge your TDS liability. Then we have two circulars, friends. I'll not go through it, but we have two circulars. In my mind, the circulars are creating more confusion, and if at all, languages also. And also, this is very important. I found in certain cases, the circulars are going beyond the law itself. And there is a very interesting judgment of Supreme Court and Bombay Court to say that when you have a circular specifically for removal of difficulty, it is only for implementation, but it cannot enlarge the scope of the section. It cannot override the section. And therefore, to that extent, if the circular is overriding the section, one can contest that it is bad and void. And these three principles now we will keep in mind when we just take 5 or 6 case study before we open up for question and answers again. So friends, first thing very important, because in a corporate advisory, a lot of question is asked to us that if there is an obligation casted on a distributor or a dealer or a distributor, whether it's a benefit or perquisite. Now, obviously, friends, if there is an obligation, I have to do this. If I'm an Asian Paint dealer, then it cannot be a benefit or perquisite. Second very key important principle which we feel is correct, personal view, is that merely because I save certain expenditure, it automatically cannot be income and a benefit. And third, as we said, and which I started with, there should be a first direct degree nexus. Now, in light of these principles, let's take a few common issues to understand. Now, friends, first issue is I have taken a loan and there is a loan waiver. Now, what happens to that? Now, when originally the section came, there was a lot of hue and cry because we know there is a lot of one-time settlement in our country which keep on happening. And then the CBDT clarified that look, per se a loan waiver according to them is income. But they said that we understand already the bank is taking a haircut. Further, I tell them to deduct tax is difficult. And therefore, they just specified certain entities which are to be excluded from 194R due to practical difficulty. Now, what happens in first principles? Now, I would feel, friends, it's still open. Obviously, whatever I'm saying is open, is subject to dispute, debate, and litigation. But can we say that, okay, there are 2-3 questions which I mean, I'll just leave it. I don't have a finite answer, but I will just leave it. One is the purpose of loan relevant? If I've taken loan for working capital and there is a waiver, generally I feel it's income. If I've taken a loan for capital asset and then there is a waiver, now can I argue that that is not income? And the reason is that you have some support from a judgment of Bombay High Court in Mahindra and Mahindra affirmed by Supreme Court. Now, critical part is what? When we read Mahindra and Mahindra, you only remember it was on loan waiver and it was non-monetary. But there was second aspect in Mahindra about Bombay High Court which says that when something is a waiver which was taken for capital, it is a capital receipt. Now, right, wrong, that has not been challenged in Supreme Court. Now, therefore, can I take a view that if it's a waiver of a capital loan, then there is no benefit, no income, and no TDS? One. Second, obviously, this question will not arise if I merely make a provision in my books. Now, on single unilateral provision, again, it cannot be a 194R which should apply. Independently of 41(1) may be applied. Third, if my bank, I have taken a housing loan from a bank, and the bank says, okay, I'm waiving part of it. Now, obviously, here we have to bear in mind, as I said, important aspects arising in the course of Ronak's business or exercise of profession. Since it's personal loan, no question of 194R. Then certain facets which are day to day. If my client comes to me and say that a bank has extended my tenure of loan. Second, if the client says that, look, I've got a moratorium. I arranged a bank finance, but now for 6 months they are giving me moratorium. Third, I have negotiated a better rate after 6 months and there's a reduction of rate. So in all these 3 cases, friends, the same principle will apply that ultimately there is no benefit. It's a saving of expenditure, not an income. And according to me, therefore, there should not be a 194R. Now you convert loan into equity. Again, that in my mind, you are paying off the loan and then you are issuing equity. It's a two transaction, but at times to avoid two-way transaction, you do it in one go. But in essence, there is no 194R. And last, friends, which we have recently seen in all these IBC proceedings, where every one of us knows that in IBC, the heart of the matter is the resolution plan. And if in resolution plan you write something which is not objected by the tax department and approved by the NCLT, that overrides the provisions of Income Tax Act. So in such cases, I have seen practically clients or lawyers draft this clause that even if there is a waiver, no income and no TDS. Then interest-free loan. Again, in my mind, if there's an interest loan given by me to a subsidiary, my subsidiary is not claiming any expenditure itself. To that extent, already is paying a higher tax. So in my mind, is arguable in such case also there should not be 194R. Similarly, no guarantee fees charged. And again, the last two items, saving of expenditure is not income. Bonus shares, the board has clarified that if you offer to all, there is no benefit. For rights, interestingly, I thought they have restricted to the fact that, okay, if you offer to everyone proportionately, in rights, there is no benefit. But we all know as professional, we always examine the rights from the context of 56, and then it all goes by whether it's proportionate or not. But here, for the sake of it, they have used the word offered and not issued. Then friends, now we come to day-to-day things. Uh, we come to day-to-day things. First things, friend, is that case study one, a company FMCG offers sales incentive, trade schemes reward, price support due to market fluctuation, which is very common because of competitive thing. If I'm a distributor of a particular product, I bought that product from the company buy sell. Because of the discount going on Amazon, the company tells me that no, I want you to sell it at 10 rupees less. I need to be protected, and the company pays me that. So in such cases, what happens? Now, I would feel if we go by the board circular, in substance, what they say that every cash discount, any such incentive is 194 are not apply only for practical difficulty. In my mind, the rightful option would be in this case, as long as you are able to issue a credit note and ensure that in day-to-day transaction that credit is captured in the future billing, I think you are much stronger. On the right hand side, I have taken a case which is also very common. I think we drew from newspaper only. There's some builder had said that, okay, if you book the flat during a particular auspicious occasion, I will give you free gold coin. I will not charge you maintenance. Now, again, the question is, in this case, let's say that I'm a dealer of that, I'm a dealer, I supply cement to that builder. But this scheme, which says that if anyone books a flat during Diwali, everyone will get gold coins. Now, whether Ronak as a distributor books a flat or any one of you as a customer, as a purchaser of flat also books a flat, everyone is going to get the gold coin. And therefore, it is very clear that it is the benefit to the distributor has not arisen because of his business, and therefore 194R should not apply. Then this case one I have taken as simple, which we discussed earlier. Like I have seen a lot of my clients, corporate clients coming to me and say that, look, I want my distributor to compulsory keep his shop in a particular manner, compulsory put my danglers, compulsory ensure that it is properly painted. And there are a lot of obligations casted on the dealer and distributor. At times, friends, the cost of that obligations is entirely met by the company. At times, it is met partly by the company, partly by the distributor. Now, in my mind, if any such obligations are there, it is not a benefit under 194R. And similar is the right-hand side case study also. Friends, like if today I'm a distributor of ice cream, now obviously the company is giving me the refrigerator. Now I'm selling, so ideally department can take away, okay, no, boss, once you become distributor, you should have incurred this cost. And why is the company incurring? But in my mind, in order to discharge the business, if it's mandatory and always ensure that it's part of the contract, then one can argue that 194R does not apply. Then friends, this free samples again, this I think we can skip that. Per se free sample is taxable, but it all depends upon a lot of facts, whether it's free for sale, not free for sale, whether a person, your dealer or distributor is going to document as to what he has done with free samples or not. Or the best part, whatever free you give, adjust it in the invoice at nil price so that it is captured. And therefore, one of the view of the department that, look, we want to track any benefit is escaping, any inventory is escaping, that can be done. Then friends, this I just highlighted as to when the benefit accrues. So this is also very common, friends, that a lot of companies, even after 194R, in order to boost the sales, offer foreign trips to their dealer and distributor. Now the question is, at what stage you should deduct 194R? Should you deduct, let's say my example, the company creates a provision on 31st March. Then the dealers are notified that, okay, you guys have achieved this much turnover, you are entitled for this trip, this much turnover, a higher trip. So then the distributor are notified. Some of the distributor will write to me, yes, I want to exercise the option of taking the trip with my family. I then go to the tour operator, book the tickets. It is refundable, not refundable, it happens. Now, here what I wanted to highlight, friends, is at what stage would you deduct tax? Now, in my mind, the only when the benefit accrues to the dealer and distributor, and when he's really able to enjoy it, at that stage only 194R should come. And therefore, if you find a situation where you say that, look, I booked the ticket, all is fine, but ultimately I can give a proof that this distributor never traveled, then I don't think he should be taxed under 194R. And last item, friends, is that this is also very common nowadays. We all have this concert culture So I have seen a lot of my clients saying, I have distributed IPL tickets, I have distributed music concert tickets to my distributor. Now there, according to me, what happens is that the ticket is per se a bearer ticket. So though I may say that, okay, I bought this 100 ticket of IPL and let us presume that it's more than 20,000 or a musical concert, then only this section will be invoked. Then in my mind, if you give these tickets to the distributor, now in this case, unlike the tour case, the moment I get any acknowledgement that I've given to the distributor ticket, now thereafter whether he uses or not is irrelevant. Because there we know that once I have given the ticket, the benefit is passed. Now thereafter whether he enjoys the show, he blacks it or he endorses it, I'm not concerned. So these are the few things which I thought day to day are there. And I think with that, I'll leave 5-10 minutes for any question answer if anyone has. And before that, I would thank everyone for a patient hearing after a great snacks. And also I would thank my team who has helped me put up this presentation. Thank you so much.
Case of this, the part of the contract.
Sorry?
Case of foreign to benefit, going to foreign to upon achieving certain turnover and etc. With the part of the agreement of contract, then 194 hours should not have.
No, sir, it will apply. See, sir, what will happen? It is undoubtedly, and I have seen this practically also, sir, that it is undoubtedly an income of the distributor. Now, so far, what is happening? None of the distributor offering that foreign tools to tax. The companies were taking the tax break. Now, department has realized. And what I meant to say, see, if there is any obligation, now here it's a benefit. I am saying that if you sell 5 crores of my paint, I will send you to Thailand. So even if I put it, whether it's part of contract or whether I put it as a promotion material or a scheme, it is nothing but a benefit to that distributor. Only case is, as we know in the circular, which is very difficult, friends, that if we say, you know, I have taken someone out for training, that is very difficult to prove that it is training, pre-day, prior day, post-day. So practically, then what we have found, most of the companies now are deducting 194 hours. And they are saying, let these people offer for tax. And at times they are crossing the tax also. Because ultimately it's market driven. I cannot do something if my competitor is, bearing the tax. Yeah.
What about pharmacy company giving free medicines to doctors?
So I would put it this, sir, that insofar as pharmacy company is concerned, it is a lot dependent on whether the terms of when you get this free medicines,
Not for sale.
not for sale. So I think because of the law there, one can argue it's not a benefit. One can argue that, but frankly speaking, now what I've seen people, I don't know right wrong, but some specimen they keep that the doctor will write, they have used this free medicine for this purpose only, and therefore he's not encashed it. So if you go by the law there, that free not for sale and all that restriction, then possibly you can argue it's not a 194. Yes,
All these credit card companies give you points for the expense.
correct,
These points are transferable to airline.
correct,
They result in upgrading your.
correct. Tickets, free tickets, yeah.
What do you have to say about?
So, sir, I would put it this way that today, any points which we get on credit card or bank card or whatever it is, see, these points per se are benefit to us. But unless you say that it's a corporate credit card, so what we found is typically all small practices, medium practices, I think what we also do is that we say, okay, let a partner swipe the card, get the bill in the company's name, but the partner is going to get the benefit of that points. Now, this is not possible to be tracked, frankly. And therefore, to my mind, there is no 194R which can practically apply. But if you say that no, like some corporates have this corporate credit card, American Express corporate credit card. Now there, if it's a corporate credit card and it has a more points, the department will find much easy that the presumption is that it is used for the purpose of your business only, and there is no personal benefit. Because in your case, you would have personally swiped the card also and got a point. So if any personal points are there or difficult to detect, then 194R practically may not apply.
Sometimes for so many companies, directors, their personal card, they use for the purpose of company's expenses.
Correct.
And then get the points.
Correct.
Then they encash the points,
So what happens next?
So sir, there also I'm saying practically I have not seen. It is difficult for it is difficult. See, it's too big, according to me, for department to go after that. Because practically in all mid-size and small firms I've seen, that is the way it happens. You never take a corporate card. Any employee incurs the expenditure, he gets a benefit of that points. And what happens, sir, that if I would fulfill that, therefore, if you want to escape R, ensure that the card is used for both purposes. Generally, we always maintain separate cards for personal, separate card for business. But there, I think if I use for both, I'm out. It's very difficult.
It was fine. Always we see the amount of points are 700,000,
Yeah.
800,000. And that value itself is more than.
Yeah.
5%.
So, sir, I appreciate. So, in fact, it's quite value. But I would put it again, even if that points are there, I would feel that trigger would always be when you use it. And another angle of that also, sir, is that can I take a view that assuming that points are benefit, when I use it for upgrade or I use for free ticket, I will say it's a discount. And board circular says that if you get something at a discount, then no 190 for us. So I will say my business class ticket is 1 lakh rupees, 1 lakh less points redeem, and therefore zero. So effectively, I mean, that board circular may help you to say that if it's a reduction or akin to discount, then I may, because effectively it's a discount only to you. It's a benefit, but it's a discount, I would put it.
Individual case, where individual spend. Get the point from the last now.
Correct.
56 to comes on.
I don't think so.
So anything you get for free.
But that way,
50,000.
but sir, that way it would mean that is it a property first? So then 56 to then you have to say कि 56 applies. Then you are thinking we can never SAB, but I would feel effectively this is a discount.
Looking at the way the AI is going in the number,
See, I think gradually, sir, gradually the way they are doing, I'm sure every one of us will have to be more vigilant. But at the same point of time, I always feel that government will have to also focus as to where to waste time, because this is going to open Pandora's box, and practically they will find very difficult. If they have to implement, it's going to be a Herculean task.
very large bank is offering a corporate card to pay your income tax.
Yeah, I know.
Statutory
I know.
5 crores.
I know.
Points are available for
Correct.
that. The value is humongous.
Correct. So presently, let's hope that they have not caught, but you are right. Gradually, they may catch us. But I think if ultimately it's used for discount, I think it's better. If I just buy something, it may be difficult. Yeah. So thank you so much.
Sir.
Thank you so much.
Thank you, Ronak sir. We are truly grateful to you for delivering such an insightful and timely session. Friends, we are recognize the presence of our Central Council member, CA Arpit Kabra ji, who is in various committee of ICAI, DAB, MSME, EGD, exam, finance, etc. He various committee, and after giving vote of thanks, he will announce two significant national development. So please be seated, and now I request our deputy convener Lalit Bansal to give a vote of thanks to our speaker. Okay. But before this, I request our past convener CA Chintan Shah and Varsha Todi to give a memento to our